Hi, welcome to my YouTube class. As we are continuing the depreciation chapter for class 11 accountancy, the last part of the depreciation chapters, it is provisions and reserves. As you know that business earns profit and all the profits certainly not distributed among the shareholders or the owners of the business, because the business wants to keep certain amount of profits for their future exigencies. Any emergencies situation arise, business keeps certain amount of profits to meet those obligations. So that the profits certainly strengthen the financial position of the business. The profits not only strengthen the financial position, but also it helps to meet the emergencies situation arise in the business needs, because business needs the funds always, so that profits certainly meet all those things. So to the some profits the business kept set aside to meet either known or some unknown liabilities. So that funds which we kept for the known or some unknown liabilities or any exigencies arises in the business to meet the future obligations. So that is nothing but the provisions and reserves. Let's discuss in detail about the provisions and reserves. There is a simple accounting treatment like depreciation. That is the provisions. Provisions is the certain amount which we kept aside by charging against the profit and loss account for a known liabilities. That is for a known liabilities. That means, for examples, that business sold goods on credit to the debtors. Sometimes the business does not expect to get the full amount from the debtors. In those situations, the business kept certain amount of profits to meet that loss arise due to non-payment of the amount from the debtors. So that amount which we kept to meet up those losses, unexpected losses in the future, that is called provisions. That is called provision for doubtful debts. Why doubtful debts? Because the debtors, all the debtors may not pay in time or may not pay even. That is a bad debts. But there is a situation, may pay, may not pay. So in those situations, we need certain amount to set aside of those unexpected losses arise due to the credit sale of goods. That is called provision for debtors. So that this is the provisions which we kept aside for the known liabilities, known loss. We know there is a loss, but we are not sure that how much loss is there. So that exact amount of the loss is unable to identify or unable to determine, but losses arises. So for those losses, we kept certain amount of profits, that is by charging against profit and loss account. This is called provisions. For example, provision for doubtful debts, provision for depreciation, already we discussed, that is the provision for depreciation. There are two methods: direct by charging the depreciation to profit loss account or through provision for depreciation account. So why we kept provision? Because we will see that after the particular some years, that expiry of the life of the asset, that asset has to be replaced. That means there is a loss, known loss is there, known liability is there. So for that known loss, we create that provisions. That is called provision for depreciation. Provision for repairs and renewals, to make the huge repairs, large amounts, not the small amount. Small repairs, it is a revenue expenses. Then provision for taxation. So these are the various examples of the provisions. Why we kept that provisions? What is the main purpose behind the provisions? The first purpose is for the anticipated losses and expenses. We create the provisions for anticipated. As I told you that we had sold goods on credit, but we are not sure that how much amount we will receive. Whether we will receive 100% or 90% or 10%, we will not able to receive. So for that 10%, we have to anticipate there is a loss and we have to create the provisions. Then determine the correct profit and loss. To determine the correct profit, we create the provisions. So that is the provisions. Let's discuss about its features, the main features of the provisions. The first feature is that is created out of current year profits. That provision is to be certainly created out of the current year profits. This year, the current year, not the future or the past years. So that is the current years. Second feature is to meet the known liabilities. That is the certain liabilities there, known liabilities there, but anticipated liabilities, not an exact amount, the correct amount, the clear amount is known to us. So to meet the all known liabilities, we create the provisions. Then third is your estimated, not exact amount. This is the things. So that is the correct thing. So that is the why we are creating that provisions. What? Because we are estimating the amount. This is estimated, expected. This is the loss, not exact amount of the loss is there. If exact amount actually it is charged to profit loss account, it is not required to create the provisions. But since there is not exact amount known to us, it is a estimated amount, so we have to create that provisions. Then lastly, it is a charge against profit and loss account. It is a compulsion. Provision is a compulsion to charge against profit and loss account. So these are the various features. I think you are more clear about the provisions. What is the provisions? Why provision is to be created? Then let's discuss the importance, the benefits of the provisions. The first benefit is to ascertain true profits. That means to find out the correct profits, we create the provisions. For example, that is the provision for depreciation or provision for doubtful debts. If depreciation is not to be charged against the profit, provision for depreciation is not charged, then certainly your asset does not show the correct financial position. There is the second importance, does not show true financial position, as well as your business will not show the correct profits, because the assets which are used for that business, which generate the profits, certainly it does not show the correct profits if you do not charge the depreciation. Likewise, provision for doubtful debts, provision for repairs, provision for taxation. You have to pay the tax, but you are not sure that how much tax you will pay. If you does not create the provision of the tax from the beginning, then certainly it is a huge burden upon your profits. That's why to reduce the burden, we are creating and we are charging that provision through the profit and loss account. So there is the to calculate the correct profits, to show the correct financial, true and fair view of the financial position, we need provisions. Then third is to fulfill the concept of prudence. That means there is the conservatism principles of accounting. Try to remember that conservatism principles of accounting. Conservatism principles of accounting or the concept of prudence says that all expected losses will be shown in the business, not anticipated profits. So as for this concept, all anticipated losses or the unexpected provision, the losses, the liabilities will be shown in the business. So that unexpected losses will be shown through your provisions. So that is the to meet the or to fulfill the concept of accounting prudence or the principles of conservatism. We charge the provisions for the profits against profit and loss account. Then to provide provision is not only to fulfill the prudence principles, the concept of accounting principles, but also it helps in providing funds for your known losses or the expenses. That means, for example, asset. You had purchased a machinery for 1 lakh rupees, which is to be used for 10 years. Its life is 10 years. You had purchased 1 lakh for machineries. At the end of 10th year, this machinery is outdated and new machinery will be replaced. When new machinery will be replaced, where you will get that funds? Immediately, 1 lakh. So that's why the provisions for depreciation is created. So 1 lakh divided by 10. So every year 10,000 depreciation is to be charged against the profits, and this 10,000 will be kept as a funds for your replacing your losses or expenditure or the asset or the liabilities in future. So there is the provide funds for your known losses or expenses. Then maintain capital balance in the business. That means to make the proper balance between assets and liabilities financial positions. We charge the depreciation, provision for depreciation. One side is correct. The other side, that provision certainly deducted from your profits, reduce your profits, your capital balance is to be balanced, equal. So that is the to maintain the equal balance of the capitals with your assets and liabilities. So we charge the provisions. So these are the various importance of provisions. So you know that is the meaning of the provisions, why we charge the provisions, then features, then importance, benefits. Then let's comes about the reserves. Reserves is another one. So why we keep the reserves? Just you imagine, we are earning 10,000 salaries per month. So if all the salaries will be done as expenditure every month, so nothing will be saved. So when you need some emergencies like health care facilities or for education of your children, so at that time where you will get that money? So to whom you will beg? Where you will get that money for your education of your children, for your medical treatments, for purchase of a building or the house, to construct a house, you need certain savings. So likewise, that savings certainly helps to your financial positions, to strengthen your financial position in the futures. So the same as you know that business earns the profits, all the profits are not distributed to the shareholders or the owners of the business. Some profits we kept aside as to meet the future unforeseen losses, future emergencies, future exigencies arise due to some unforeseen losses. That means any amount kept aside out of the current year profits of the business to meet known or unknown liabilities. So here it is a known liabilities provisions, but reserves it is either for known or unknown liabilities. That means we are not sure for what purpose we will use it. Just like of your savings, you save money in the bank. So whenever you need, you draw those money and use it. So you do not know whether for this purpose you have kept or for that purpose you have kept. So whatever it may be, that you have kept savings, those savings you use it to meet your losses or to exigencies rise or to meet your requirements. So to fulfill of these requirements, the business also maintain the reserves. that is out of your profits. So reserves is an appropriation against the profits of the business. Reserves is not compulsory. It is a voluntary contribution by the business to maintain the financial, to strengthen the financial position of the business in future. That is to meet the contingencies that arise in future, or to strengthen the financial position. Either it is for some known or unknown liabilities which are arise in future due to contingencies or exigencies, or to strengthen the financial position of the business. So that is the reserves. So certainly that reserves will help to increase your financial position of the business, to strengthen your financial position of the business. So then let's see that the features. There is no concept of accountancy applied here. That is only for your strengthening financial position we maintain the reserves. But as for the prudence principles of accountancy, prudence concept, we create the provisions. So let's see the features. First features of the reserves is, it is an appropriation against the profits. It is appropriation, it is not a charge against the profits, because it is appropriated. Before distributing the profits to the shareholders or the owners of the business, we kept certain amount of profits out of divisible profits, not out of the profits charged against profit and loss account. Out of divisible profits, some profits have to be kept, 10%, 20%, 25% as a reserves. So this is appropriation against profits. Second is it is voluntary. It is not compulsory, but provision is a compulsory. Side by side I am talking about the difference also. Provisions is a charge against profit and loss account. It is a charge. It is a charge against profit and loss account, but it is a appropriation against profit and loss account. Provision is compulsory, but reserves is voluntary. It is your wish. You should do savings, may not do savings, no problem. If you do savings, it increases your strengthening the financial position. If you do not do the savings, certainly you will face the problems. So that is it is not value. It is a voluntary contribution. Then third is it shows in the liability sides of the balance sheet under the reserves and surplus. It is a separate head shown in the liability sides. But provisions is not shown in the liability side of the balance sheet. Either it is deducted from the concerned assets or set up against the particular losses or expenses. So fourth feature says, it is if that reserves which you had kept aside from the profits, which is a divisible profits, the amount of the profits which you kept aside, if you invested outside the business, then we call it is a reserve fund. This is called a reserve fund. That means amount of the reserves you create, invested outside the business, either in the bank or some other areas, that shares, debentures, etc., that is called reserve fund. So the examples I am giving about the reserve fund: debenture redemption fund, investment fluctuation fund, your capital, that is the dividend equalization fund, workmen's compensation fund. These are the various funds, the reserves which are invested and create the out of by crediting the profits and charging to appropriation against the profits, credited to the profits, that reserves and invested in a funds and earn some interest or the benefits. That helps to replace your particular liabilities or particular losses to meet in the future. So there is the reserve fund. And fifth is it is not known for the liabilities. It is not for known liabilities. If you know it that this is a liability side, I am creating that reserves. Not like that. Reserves is not for that. Provision is this. So provision is created for known liabilities, whereas reserves is not for known liabilities. It is for unforeseen losses or expenses. It is not for the particular reasons. It is created for any purpose. Created for anything. Then impotence of the reserves. The first impotence is it strengthens the financial position. Already I told you that reserves strengthen your financial position. Reserves, examples of the reserves: dividend equalization reserves, workmen compensation reserves, general reserves, the debenture redemption reserves, investment fluctuation reserves. These are the various examples of reserves which we create to strengthen our financial position. Then second is it made unforeseen liabilities or losses in which are arise in future. It is unforeseen liabilities or losses which we cannot see, but suddenly it arises. I have told you that we create the savings, suddenly there is an accident. You need 1 lakh of your medical expenses. If you have saved, suddenly it will meet this. That savings is nothing but the reserves. Business face the huge losses due to competitions, due to accident, due to sudden fire in the godown. So this leads to liability, huge losses. That huge losses will be set up from your reserves. Then third is maintain uniform rate of dividend. That means when you are paying the dividend to the owners or the shareholders, that dividend will be maintained uniform. Last year you had paid 10%, this year profit reduced, so you cannot pay the 10% dividend. What you will do? If you pay less rate of dividend, so suddenly the owners or the shareholders will be dissatisfied. So in these situations, the reserves which we had created, out of that reserves, some amount will be brought to make the uniform rate of dividend at least, so that shareholders will be satisfied. So this is the maintaining uniform rate of dividend. Then to meet the legal requirements, for the legal provisions, as per the legal requirements, we need to maintain the reserves. Like for example, investment fluctuation reserves, workmen compensation reserves. For the workmen, the workers who are working in your organization, they need certain compensation for accidental losses. For some other reasons, they demand certain loss, use compensations. So at the time, those reserves is to be utilized. So as per the law, we create the reserves. Then provide funds for your specific liabilities. It provides the huge funds for replacement of your assets, for replacement of losses, for replacement of your any technologies which have to be needed for your organizations. So that is for any unknown liabilities, only not for any specific needs, but provide funds for your some purpose. So that is the importance of the reserves. Now comes the reserves, classification of reserves or the types of reserves. Reserves are classified into two types, that is revenue reserves and capital reserves. Revenue reserves, reserves created out of normal profits of the business, that is called revenue reserves. That means the profits which are created out of buying and selling of goods, trading of goods and services, that profit is to be transferred to keep set aside some portion of profits for the reserves, that is called revenue reserves. Revenue reserves again classified into two types, general reserve, specific reserves. General reserves for any purpose, you can use for any purpose of your general reserves, that is called general reserves. It has not specific use, but specific reserves is used for certain specific purpose, for some specific requirement. For example, that workman compensation reserves, it is for only for the workman's compensation purpose will be used, not for any other use. Dividend equalization reserves for the payment of dividend, to maintain a uniform rate of dividend, we need that reserves. So, debenture redemption reserves, for the redemption of debentures, refund of money to the debenture holders, we create the debenture redemption reserves. So, this is specific reserve for some specific purpose, that is called specific reserves. So, there is the revenue reserves, general reserve, specific reserves. But capital reserves, the reserves which are created not out of the revenue profits but out of the capital receipts or the capital profits. Capital profits are profit prior to incorporation, means profit before business, before starting your normal by trading business, you earn certain profits. So that profits is transferred to capital reserves. Profit from the sale of assets, fixed assets, that is transferred to capital reserves. Profit by forfeiture of shares, that means cancellation of shares, you earn some amount, that profits, that is transferred to capital reserves. Profit from the redemption of debentures, you have redeemed the refund the amount of debentures to the debenture holders and you earn some amount. So that profit transferred to capital reserves. So these are the various capital profits, capital receipts, that means any receipt which are not normal, routine from the sale of goods and services, but from other sources, those profits are capital profits and transferred to capital reserves to create the capital reserves. So all the reserves are used for your business needs. And lastly, there is the secret reserves. Secret reserves is not disclosed in the balance sheet, but it is created. Like that reserves is also known as hidden reserves, which is not shown in the balance sheet. Reserves will not disclosed in that balance sheet. That is called secret reserves. It is kept secret. Only the business management or the owners or the shareholders knows that secret reserves is created. So secret reserves is created out of the different profits, like excess charging of depreciation. Normal depreciation 10%, but you charge 12%, 2% extra charge, that 2% goes to secret reserves. That excess overvaluation of that overcharging of expenses, that means more expenses charged, profit reduced, that expenses will be transferred to secret reserves. That overvaluation of stock, excess valuation of stock, that reduces your profits, that goes to your secret reserves or the hidden reserves, or that is your excess valuation of your assets, liabilities. So that excess valuation assets shows more amount, so that will be goes to your secret reserves. So these are the secret reserves. And reserves of fund, already told you, if the amount invested outside the business, we call it reserve fund. That means debenture reserves, redemption reserve is created. If the same amount we invested outside the business in the shares or the stock to earn the profits, so that is called debenture redemption fund investment. So that funds will have certainly helps in replacing your debentures for the repayment of money. So this is about the reserves. This is about the provisions we had discussed. So we had understood it clear. Thank you.